The U.S. labor market is showing clear signs of a labor recession, a prolonged period of weak hiring, stagnating job growth, and rising layoffs. In November 2025, private sector payrolls unexpectedly contracted, with a loss of 32,000 jobs according to recent data. Meanwhile, broader labor market indicators confirm the chill. According to J.P. Morgan, U.S. payroll growth has slowed to just 0.6%, among the weakest levels historically outside of major crises. Hiring activity has cooled sharply. The number of open jobs has declined, and the pool of new vacancies is shrinking across many sectors, especially in professional services, finance, healthcare, and retail. At the same time, layoffs are rising. In October 2025 alone, a wave of mass layoffs eliminated over 172,000 jobs, the largest monthly cut since the pandemic, hitting sectors like technology, retail, and corporate services particularly hard. Although the headline unemployment rate, estimated at around 4.4%, has remained stable, underlying dynamics paint a more troubling picture. Alternate data sources show persistent job losses in sectors including leisure, retail, and manufacturing. The slow pace of hiring, combined with layoffs and increasing uncertainty, suggests that many Americans are quietly caught in a period of economic stagnation, with fewer job opportunities, slower wage growth, and growing difficulty for new job seekers. Analysts argue that structural shifts are behind this slowdown. Advances in automation and artificial intelligence are reducing firms' incentive to expand headcount, even as companies invest heavily in tech infrastructure. Meanwhile, macroeconomic headwinds, including trade policy uncertainty, elevated inflation, rising interest rates, and tighter financial conditions are prompting businesses to freeze hiring or downsize staff. The consequences are real for workers. For many, steady income and career growth are no longer guarantees. Gig workers, recent graduates, and those in sectors like retail or hospitality are feeling the pressure most. With fewer openings and heightened competition, job security has eroded, and even employed individuals may worry about stagnating wages, reduced hours, or future layoffs. As the labor market cools, consumer behavior is changing too. Household budgets are tightening, and spending on non-essential items is declining. Combined with rising prices and economic uncertainty, many families are being forced to rethink their financial plans, from saving and investing to career decisions and lifestyle choices. In this new environment, financial resilience matters more than ever. Building an emergency fund, reskilling for in-demand skills, diversifying income streams, and being careful about debt are practical strategies to weather the downturn. For young workers, in tech, retail, or service sectors, adaptability and continuous learning may become the key to surviving and thriving in a labor-scarce future. Stay informed, stay prepared, because the labor recession isn't a momentary hiccup. It may reshape the U.S. job market for months to come.